All right, today we're putting a stock under the microscope, one that has just rocketed past the rest of the market, leaving pretty much everyone asking, wait, what just happened? We're talking Force Motors, and we're going to dig into the story behind its incredible breakout.
I mean, just look at this chart. Over the past year, while the main Nifty 50 index gave us a solid 11% return, Force Motors put up a staggering 250%. That's not just beating the market, that is leaving it in the dust. A move that big? You gotta ask why.
So how does one single stock pull off a move like this? And that's the big question, right? So we've been digging through the research. And you know what? We're going to treat this like a little investigation, piecing together all the clues to really understand the anatomy of this breakout.
Okay, so our investigation? It kicks off with one single pivotal moment, the event that shattered a long-standing barrier and changed absolutely everything.
So picture this. February 9th. After months of just trading sideways, the stock suddenly gapped up, surged higher, and closed at a lifetime high. And look, this wasn't just a good day. No, this was a massive signal, a flare going up that told the entire market, hey, pay attention, something has fundamentally changed here.
All right, let's get into the nitty-gritty. Every investigation starts at the scene of the crime. And for us, that scene is the stock chart. It's literally full of clues, right? It tells us about the psychology of the buyers and the sellers that led us to this exact moment.
And this number, this is clue number one. And honestly, it might be the most important one, 21,933 rupees. For months, this price was like a brick wall. The stock just couldn't get past it. So what was it?
Well, in market speak, that's what we call a major resistance level. Think of it like a ceiling. Every single time the price tried to punch through it, sellers would just show up and push it right back down. But on February 9th, the buyers didn't just knock on the door, they blew the whole thing off its hinges.
And what you're seeing here, this is textbook stuff. It's the classic anatomy of a breakout. First, you see the price coiling up with tension, just simmering right below that ceiling. Then, bam, a sudden surge in trading volume. That's the rocket fuel. And finally, the price explodes through the ceiling on that high volume, confirming that the big players, the institutional money, they are all in on this move. Okay, but here's where the plot thickens. This is a really fascinating twist. A month earlier, the chart formed what's known as a double top, which, 9 times out of 10, is a really bearish signal. It screams, the price is about to drop, but it didn't. And when a bearish pattern fails this spectacularly, it's like a slingshot. All those traders who bet against the stock, they're trapped. They're forced to buy back their shares to cover their losses, and that buying just adds even more fuel to the fire.
But listen, a pretty chart pattern, that's not the whole story. It's never enough. Every big breakout needs a motive. There has to be a real, fundamental why behind all that buying pressure. So, what was it?
It was this, a 252% increase in the company's Q3 net profit, year over year. I mean, just let that sink in. This wasn't just a good quarter. This was a blockbuster. This was the kind of result that makes investors sit up, tear up their old spreadsheets, and completely rethink what this company is capable of. But you know what's really amazing? It's how they did it. So yeah, sales were up a respectable 12.7%. That's nice. But profits? They exploded by over 250%. What does that tell you? It screams incredible operational efficiency. For every extra rupee they made in sales, a huge chunk of it fell straight to the bottom line. And let me tell you, the market absolutely loves to see a company become that kind of profit machine.
And that efficiency? Well, there's a great metric for that. It's called return on capital employed, or ROCE. It's a simple idea, really. It just asks, for every dollar you put into the business, how many dollars of profit does it spit out? Well, Force Motors' ROCE surged to around 37%. Now, to put that in perspective, for a company like this, anything over 20% is considered really, really good. So 37%? That's a giant flashing neon sign for investors that says this company is an incredibly efficient profit-making machine.
Okay, so now let's put all the pieces together. When you take those technical clues from the chart and you pair them with the powerful motive of these explosive profits, well, suddenly you've got a really compelling story.
It really was the definition of a perfect storm, wasn't it? You had the clean technical breakout, you had the explosive earnings, you had that failed bear trap adding rocket fuel. All of this was backed up by other momentum indicators all flashing green. And the best part? The whole thing was built on this massive, long-term chart pattern that hinted, hey, this move has got legs.
And that big pattern I just mentioned, It actually has a name. It's called a rounding bottom. Just think of it like a giant slow U-turn happening over many, many months. And based on the sheer size of that pattern, the technical analysis points to a potential target of around 33,800 rupees. Now look, this is just a projection, right? It's based on the geometry of the pattern, but it gives you a sense of the scale of the move that investors are now pricing in.
But, and there's always a but, right? In any good investigation, you have to look at all the angles. Nothing is ever a guaranteed slam dunk. So we absolutely have to talk about the risks and what could go wrong.
So, okay, the story sounds great, but is it a sure thing from here on out? The short answer? Absolutely not. There are always risks, and a smart investor always knows they're out. They have a plan for what to do if the story falls apart.
And this is exactly how the pros do it. This is how they manage that risk. They draw lines in the sand. So if the price closes back below that breakout zone, around 21,200, the immediate breakout thesis is busted. And a drop below that really critical level, around 16,400, well, that would be a major red flag that the whole long-term bull run is in serious trouble. Knowing where these levels are is everything. And it's not just about the chart. On the fundamental side, there are some potential headwinds to keep an eye on. For example, if export sales stay weak, that could be a drag. The stock's valuation is pretty high now, which means it's basically priced for perfection. Any little slip-up could hurt. And, the whole auto industry is cyclical. If the economy slows down, they're going to feel it. These are real things that could challenge this whole bullish story.
Which brings us to the real takeaway here, and honestly, the report we're looking at sums it up perfectly. Remember that number we started with, 21,933? Well, it's undergone this really powerful transformation. What used to be a ceiling, this unbreakable barrier holding the price down, is now expected to become the new floor, a support level that could hold the price up.
And that really leaves us with one last big thought to chew on. You see, by putting together a crystal clear technical picture with a super powerful fundamental story, the market has completely changed the game for this stock. So the question now is, when a ceiling becomes the floor, just how high is the sky?